You were told diversification is safety. Own a little of everything. Spread the risk. Sleep better at night. So you did. Stocks, ETFs, funds inside funds, geographies you've never visited. And yet, when markets fall, everything falls together. This isn't protection. It's dilution. Diversification sounds intelligent, academics, responsible. It feels like adulthood in financial form. They told you volatility would disappear. That risk would cancel itself out. What they didn't tell you is what diversification actually does and who it really serves. This is the fake diversification trap. Not diversification itself, the illusion of it. Diversification is supposed to mean independence. Assets that move differently, respond to different forces, fail for different reasons. But modern portfolios don't diversify behavior. They diversify labels, different names, same engine. When everything is priced in the same currency, traded on the same exchanges, reacting to the same liquidity, it's not diversification. It's correlation wearing a disguise. Here's what really moves markets. Not fundamentals, not long-term value. Liquidity. When liquidity tightens, everything reprices. Stocks fall together, ETFs fall together. Diversified portfolios fall together. The trap isn't volatility. The trap is believing you escaped it. ETFs made diversification easy. Too easy. One click, instant exposure. But look closer. Many ETFs own the same underlying assets. The same companies, the same sectors, the same risk, replicated. You didn't diversify risk. You multiplied exposure. Fake diversification feels safe because it reduces decision-making. You don't need conviction. You don't need understanding. You just own everything. And when nothing outperforms, you blame the market, not the structure. The system loves fake diversification because it keeps money passive and behavior predictable. You don't question holdings. You don't challenge structure. You stay invested, but uninvolved. This is perfect for everyone except you. Meet Laura. She did everything right. Diversified portfolio, long-term horizon, low fees. When markets dropped, everything dropped. Her bonds didn't protect her. Her international exposure didn't save her. Because diversification wasn't real. It was theoretical. The fake diversification trap survives because it sounds scientific. It's backed by models, charts, assumptions. But models don't live through crises. People do. And every major crisis exposes the same truth. Correlation rises when it matters most. Real diversification isn't about quantity. It's about differences, different risk drivers, different time horizons, different roles, assets that behave differently because they are different, not because they're named differently. Most resilient portfolios aren't crowded. They're intentional. Each asset has a job, one for growth, one for stability, one for optionality. When you understand roles, you stop collecting assets. You start building systems. More holdings don't reduce risk. They reduce clarity. You don't know what's working. You don't know what's failing. You can't rebalance intelligently because nothing is distinct. The trap isn't lack of diversification. It's lack of intention. Diversification isn't about safety. It's about survivability. It's not about avoiding loss. It's about avoiding ruin. That requires understanding, not accumulation. You don't need to own everything. You need to know why you own anything. Once you see the fake diversification trap, complexity loses its appeal. Simplicity becomes strength. If fake diversification diluted your returns, the next system drains them entirely. The next video exposes the biggest wealth leak hiding in plain sight. Watch next. The middle-class wealth leak. Car payments, lifestyle inflation. If this challenges how you view your portfolio, leave a comment, and subscribe. Because once you see the trap, you stop stepping into it.